Hello CFA friends, in this derivative reading we will look at option markets and contracts. So let's get started. Okay, first of all we will remind ourselves of what a call and put options are, very basic level 1 material. Obviously this is the foundational concept for what is to come today. So in terms of options, they give us right to buy or sell an asset at a point in the future, but certainly not the obligation to trade. So remember, options are very different from forwards, because forwards were commitments to definitely trade in the future, even if that meant to trade at a loss, whereas options will only allow us to trade if we desire to do so, and of course if we can generate profit. Of course, on the downside, options do come at a cost, which is the premium, the cost of the option. So call options give me the right to buy, put options give me the right to sell. And to remember the payoff of a call option from level 1, for a call this will be the greater between 0 and the underlying price minus the strike price. Remember, strike price is simple lingo for the price at which we are able to buy the underlying asset. And remember, the reason why we're doing greater of 0 and s minus x is because if s is less than x, if the underlying is below strike, then of course we won't exercise the option, and our minimum payoff can never be less than 0. So remember, this is a rule, an option payoff can never be negative. Now in terms of the put option, this gives us the right to sell, so the payoff will be the greater of 0, and if I do come to sell, I collect the strike price by delivering I minus the underlying price. Again, payoff of a put option can never be less than 0. And of course, we've got options in terms of when they can be exercised. Now, of course, there are lots more options, and there's an entire world of exotic options, but here we're just going to focus on the plain vanilla European options, which can only be exercised at expiry, and American options, which can be exercised at any time before expiry as well as expiry. So they're more flexible compared to European options. And of course, this brings us to that key equation that we learned at level 1, which was the put-call parity equation. This is still a very, very important relation for level 2. In a minute we will show you why it works, but let me just go through the components here, just making sure that you guys know what each of these components are. So starting from the left hand side, we have a European call option. Then we've got an interesting instrument here. This is a 0 coupon bond whose face value will be equal to the strike price of the call option. So it's a very, very strict definition. It's not just any random 0 coupon bond. It's a 0 coupon bond whose face value has to be the strike of the call. That is an assumption we cannot violate if we want this equation to work. The right hand side, we've got a European put, and then we've got the actual underlying asset represented by S. Now we do have names for this thing. So the left hand side of the equation, i.e. the side of the equation that has a European call and a 0 coupon bond, is typically called fiduciary call. Okay, the idea behind, or some people actually call it principal protected note, because the idea of this product is that the 0 coupon bond provides protection for your capital. Worst case scenario, even if the call option expires worthless because the underlying has tanked, you would still get the face value of the 0. Of course, that 0 is a risk-free zero coupon bond issued by a high-quality government. So for that reason, we call that product a fiduciary call. You either get your principal back, or if the underlying asset does particularly well, then the call option is in the money, and therefore you get even more. On the right-hand side, we've got a very well-known strategy. You should be familiar with this strategy from level 1. This is quite simply your protective put from level 1, i.e. we've got a stock, and on top of that we've got a put option. Now, in the next few minutes, we're going to prove that even though they may look very different, both of these strategies are achieving exactly the same result. So let's have a look at this. Right. So first of all, let's divide our screen. On the left-hand side, we will look at the performance of fiduciary call. And remember, the fiduciary call has a call and a zero coupon bond whose face value is equal to strike. On the right-hand side, we will have a protective put, which will have a European put and an underlying asset. And we will look at all states of the world. So we could simplify this into two states of the world. First states of the world, bullish scenario, the stock price is doing better than the strike, i.e. at expiry the stock price exceeds the strike, so the call option is in the money. And in scenario number 2, the bearish scenario, the stock price has expired either below the strike or it is equal to the strike. So let's have a look at each scenario individually. So in scenario number 1, if the stock expires above the strike, then the call option is in the money and therefore pays me. Remember, call gives me the right to buy, so I buy the underlying paying strike. So the call payoff is S minus X, and then the bond expires to pay me face value of X. The net profit from this is, of course, S, which is the stock price. In the bear scenario, where stock price has expired either at or below the strike price and the call option expires worthless, remember the payoff says it's either S minus X or 0, whichever is greater. So in this case, 0 would be greater, because if we were to exercise, we would be losing money. So the call option is out of the money. 0 payoff there, but the bond still pays strike or X. So the combined payoff here is X. Okay, fair enough. Now moving on to the protective put. In the bull scenario, the put, which is meant to provide downside protection, will expire worthless, but in a protective put you would still have the stock. So the combined payoff will be S. And in the bear scenario, stock under strike, the put will be exercisable, so we'll exercise to receive strike by delivering the underlying, i.e. X minus S, but we'll still hold that underlying in the original position, so on a net basis this will give me a payoff of X. Now look what happens. Let's change color for this one. Look what happens. In the bull scenario, both strategies result in a value equal to the price of the underlying at expiry, and in the bear scenario, both strategies result in a payoff equal to the strike price of the call. By the way, the strike price of the call and the strike price of the put are the same, and they coincide with the face value of the 0. So what could you say at that point? Well, in all states of the world, both strategies give me the same answer, so they must be equivalent strategies. So we can now conclude that call plus bond, and we can describe the bond as the present value of strike, because this is the price of the 0 today. This fiduciary call must be equivalent to a protective put. And just do remember that both the call and the put have to be European style in order for this to work exactly. And as I said, this is a very important equation, so please don't ignore it. Please know this equation. Now, what can we do with this equation, guys? Going back to our slides, what we can do with it is we can, first of all, rearrange it to create synthetics. Now, what is a synthetic instrument? A synthetic instrument is an instrument that we create as a combination of the other three instruments in the put call parity. So, for example, I could create a synthetic call by combining a stock, a put, and a bond in the correct way. Now, this is not the most intuitive thing in the world, so I'm not going to be expecting you to sort of off the top of your head say, oh, by the way, a call is created by longing A and shorting B and longing C. So the best and safest way to know how to create a synthetic is to start with the put call parity and simply rearrange it. So in our put call parity, we've got call plus bond is equal to put plus stock. I want to create a synthetic call. Nothing easier. I simply need to isolate the call on the left-hand side. So moving the bond across the equal sign, of course, will change the sign in front of the bond, and so we end up with this particular equation. Now, key point. What does plus mean in this equation? Well, plus will mean that you've gone long that product, much like minus will mean that you've gone short. So in the case of the scenario where you were asked to create a synthetic call, the answer is to simply read out that equation back to the examiner. So to create a synthetic call, I have to buy a put, plus B means buy a put, buy an underlying asset, but the minus means that I need to short a zero coupon bond. Now, the examiner may also use other types of words. For example, when you short a bond, what is that really equivalent to? Well, shorting a bond is equivalent to borrowing at the risk-free rate, right? Because when, for example, Uncle Sam sells treasuries, what he's doing is he's effectively borrowing money. So shorting a bond is equivalent to borrowing at the risk-free rate in this particular model. Okay, well, let's have a look at some other scenarios. We can, as you can imagine, also create a synthetic stock, synthetic put, and synthetic bond. Okay, well, let's try one more. We don't have to try all of them. Let's try creating a synthetic stock. So to create that, we need to buy a call option. The minus here means that we need to sell the put. And another word that could be used here is write a put, because selling and writing a put is the same thing. And plus PVX would imply that this time you have bought the zero coupon bond. But of course, again, we could have used other words. Could have said a long, or we could have said invest at the risk-free rate, or we could have said lend at the risk-free rate. They're all possible words which essentially mean exactly the same thing. And okay, I'm not going to cover these two, but of course they will work in exactly the same way. So my suggestion for you guys on exam day, if you get a scenario like that, take a deep breath, write out the plain vanilla put call parity theorem in the margin to your exam book, rearrange it to isolate the product that they are asking for, and then read it out essentially to yourself and select the correct MCQ option. Now, we want to move to the binomial model or binomial tree. And of course, this is a level 1 topic. We did sort of show what a binomial tree looks like at level 1, but we never actually got to tell you what you could do with this fantastic newly acquired knowledge. So let me just give you a little bit of warm-up before we look at any numbers. So first of all, binomial tree would imply that we assume there are two states of the world. There's an up state in the world, there's a down state of the world. And of course, at level 1, we developed the idea of the binomial stock price tree. So I could tell you that my stock price today, S0, is $10. And because I'm using a binomial, not a trinomial tree, which by the way is not on the syllabus, so don't panic, only looking at binomial trees, I'm now assuming that only two things can happen to the stock price. Stock price can go up or stock price can go down. Now, how do I know by how much the stock price is going to go up? Well, in the up state of the world, I know that it's going up. I need to be given what's known as the up factor. So, for example, if you are told that the modeler believes stock price can go up by 20%, then your up factor is nothing but 1 plus 20%, or 1.2. So take $10, multiply by 1.2, and you would get your expected stock price at time 1 of $12. At the same time, the down state of the world, you could be given a down factor, let's say, of 0.8. Now, this will imply that if there is indeed a decline, the decline will be 20%, much like the increase here was 20%. Again, nothing simpler than that. Take $10, multiply by spot 8, and you will get the expected stock price in the down state of the world as 8. Now, on top of that, now I could be given the idea that someone wants me to value an at-the-money, remember at-the-money call option. 1 year at-the-money call option. Now remember, from level 1, the meaning of at-the-money is that the stock price is actually equal to the strike price of that particular option. Okay, so stock price equal to the strike price of that particular option. So in other words, there is a hidden way of telling us that the strike price of this at-the-money call option has to be $10, because today's stock price is $10. Now let's change colors again and look at the actual call payoff. Well, remember, the payoff of a call is call payoff. Okay, the payoff of the call is the greater of 0 and s minus x. So, in the up state of the world, the call value is 12 minus 10, or $2. Okay, and in the down state of the world, because 8 minus 10 is a negative number, we don't like to exercise to lose money, it's only an option, the call value is $0. Okay, so it's all going to be very conceptual. I'm not going to actually finish this exercise, I'm just trying to help you warm up for the topic. Now, how am I going to know the value of the call today? Right, and here we go back to the basic expectation theory and probability theory and time value theory. So the value of this call option at the end of year 1 is nothing but the expected value of the option. So I need to take that famous $2 possible payoff and multiply it by what I believe to be the probability of this up move. Now I don't know what this is, so I'm just going to call it pi u, which would be the probability of up move, and then I'm going to have to add the down state of the world, which is $0, times the probability of a down move. Now, because these are mutually exclusive and exhaustive events, if you want to throw in some fancy words from level 1, the probability here is simply 1 minus pi u. Okay, we don't really need that second bit, because as you know, whatever that probability is will be multiplying by 0, so it will go away anyway. Once I've got that though, this is only giving me the expected value of the call at time 1. I still want to bring that back to today, so I'm going to be discounting at the ratio rate to the power of 1 in this case, because I've got 1 year to expire. So this is just a conceptual question to get us started in the topic of what a binomial tree is and why we use it. Now, what I'm not telling you on this slide yet is how we calculate this probability of an up move. Now, this probability of up move is not the actual probability that we observe in the market. This probability is based on a model of risk neutrality. A model of risk neutrality. So for that reason, that pi u, that probability of up move, as well as the probability of down move, are known as risk neutral probabilities. So in other words, they assume that we live in a risk neutral world where everyone's happy and every asset is growing pretty much at the risk-free rate. So there's no risk pretty much. So we can therefore derive the risk neutral probability of an up move, which I'm not going to derive today on this video, because I think it's better value for money for you to simply rote learn this formula. It's not particularly difficult, and it takes less time to rote learn it than to derive it. So if we assume that we live in a risk neutral world, what we need to do here is take 1 plus the risk-free rate minus the down factor. Remember, the down factor is basically the factor we use to estimate the price in the down state of the world. In the denominator, we have the up factor for the up state of the world minus the down factor. Okay, well, now we're going to change the numbers here. But if we were given an up factor of 115, of course, that implies that your modeler believes that in the up state of the world, the stock will go up by 15%. Now, unless you're told otherwise, so unless you're told something specific about the down factor, you must assume for the CFA program, and this can differ if you are sitting for other programs such as the FRM, but for the CFA program, you will have to assume that the down factor is nothing but the reciprocal of the up factor. So this is unless told otherwise. So if my up factor was 115, all I need to do is 1 over 1.15. And this happens to be spot 87. And of course, this implies that on the downside, the approximate decline we expect to see is about 13%. So if the stock were to go up, it will go up by 15%. But if it were to go down, it will go down by only 13%. And you might think, oh, that's a bit weird. Why would it go up by 15%? Well, maybe I was expecting it to go down by 15% as well. But there's a good reason why we can set up our model in this way. If we set the down factor to be the reciprocal of the up factor, then what happens is that if we've got two periods, so up, down, up, down, up, down, we can say with certainty that if our stock price today was $10, or in this case $30, it doesn't matter, okay, let's use $30. If our stock price today is $30, it will also have to be $30 in 2 years' time if one of the movements was an up movement and one of the movements was a down movement. It doesn't actually matter in what order these movements occurred. For example, I could have had an up-down movement and I'll go to 30. I could have had a down-up movement and I would still end up at 30. And the reason why this occurs is because the down factor is defined as the reciprocal of the up factor. Okay, so far what have we discovered? We've discovered our up factor, we've discovered our down factor, we've then worked out our risk neutral probability of an up move. If you want to actually see how we got the 71.5, we will need that risk-free rate of 7%. So the actual computation you need to perform is 107 minus the down factor of spot 87 over up factor of 115 minus spot 87. Okay, try this on your calculators, guys, and I hope this will give you 71.5%. No, I hope, I'm actually certain, because maths is not going to be a matter of opinion. And of course, if you've got the probability of an up move, then all you gotta do is take 100%, knock that off, and that'll leave you with 28.5 probability for the down movement. Okay. Now, we are going to start by projecting our share price tree over one period or 1 year. So starting with $30 today, we multiply that by the up factor, and we get 34.50 in the up state of the world. And in the down state of the world, we multiply 30 by spot 87, and we get 26.10. So that is the first step. You cannot validate the option unless you first have an idea of what your stock price will be worth 1 year down the road. Yeah, why did we create the tree? Well, kind of preempted that. We're creating this tree because now we've got the expected share price is 1 year down the road, and so we can potentially value a 1 period call option. And the strike of this call option is $30. So this, in fact, is indeed an at the money call option. Okay, so in the up state of the world, where the stock price was 34.50, the payoff will be the greater between 0 and the difference between stock price and strike. Well, of course, stock price minus strike gives me 450, which is greater than 0. So I'm going to keep that as my payoff in the up state of the world. In the down state of the world, the stock price is 26.10. Now, if I try this formula again, max of 0 and 26.10 minus 30, well, this time the formula will evaluate to 0, simply because the option is out of the money. So, in a nutshell, in the up state of the world, we shall carry this value, and in the down state of the world, we shall carry this value, the 0. Okay, so we're now ready to complete our tree. So here's the completed tree. So in the up state, we've got the famous 450 payoff. In the down state, we've got the $0. And of course, this is only part of the cocktail. The other very important ingredient will be the probability of an up move, which is 71.50, and the probability of down move, which is just 1 minus PU, or pi u, if you prefer Greek letters. Okay, so once we've got that, let's put it all together and see what happens. So the co-value today will be, let me just annotate what these guys are. So, firstly, we've got the call in the up state of the world. So let's denote this as C+. We've got the 71.5, which is the probability in the up state of the world. Then we've got the 0, which is the call in the down state of the world. And the probability of down state of the world will simply be 1 minus pi u. And of course, this top line, the numerator of this equation, provides me nothing but the expected value of that call option at time 1. We are valuing the call option today, so we now need to apply a little bit of time value of money. So we divide by 1 plus the risk-free rate, which in our case is 1.07. So as a result of that, we obtain the price of the option today as $3. Great. Guys, give yourself a tap on the shoulder, because officially you've completed the first option valuation with a binomial tree. And I know it's a little bit meaty, it's a bit of a time burner. In an exam scenario, I probably won't be starting my exam with a binomial tree valuation, but once you get the hang of it, I think it's really not too bad. It's just mechanics, just putting in the numbers and doing a little bit of number crunching. So that's as far as binomial stock price trees go. Now, we have a slightly different binomial model as well, and I don't want you guys to be confusing the two. So the one that we just looked at was essentially dedicated to valuing calls and puts on equity. So the binomial tree was there to forecast what future share prices might look like based on up and down factors and stock volatilities and whatnot. The second binomial model we'll look at is the binomial interest rate model. And in this model, we're doing something slightly different. So we're basically starting with the 1-year spot rate today, say this is 3%, and based on yield volatility, an assumption of yield volatility, so sigma of yield, based on this assumption of yield volatility, we then forecast the possible 1-year forward rates 1 year from today. So they could be possibly 5% in the upstate of the world and 4% in the downstate of the world. So here we're not even looking at share prices, we are looking at interest rates. So shocking these interest rates based on yield volatility. And one key difference that we notice in this tree is we no longer use the risk-neutral probabilities. We use much simpler, this is going to come as good news for sure, guys, we use the much simpler 50-50 chance. So there is a 50% chance that rates will go up. Similarly, there's a 50% chance that rates will decline. Again, it's a binomial structure, so there is no chance that rates will actually flatline over one step. Okay. Now, why are we going to use this? What kind of scenarios is this going to apply to? Think about it. You're shocking interest rates, so anything to do with bonds is going to be applicable. So if you want to value bonds themselves, or if you want to value callable bonds or puttable bonds, the very options embedded in those bonds, or if you want to value a call option to buy a bond or a put option to buy a bond, this is your territory. This is your model to use. So this is what the interest rate looks like, interest rate tree, and this is obviously over 2 periods. So this first thing is the 1-year spot rate today, whereas everything else are possible 1-year forward rates estimated based on yield volatility. Okay, so what do we do with this? As I said, we can calculate the value of options written on fixed income securities. And what is the conceptual steps that we need to take? First of all, we need to price the bond at the end of the tree. Okay, this is the famous idea of backward induction. We start with something we know with certainty at the end of the tree. Well, of course, we know that no matter what path interest rates take, a bond always matures to pay face value. Okay, we ignore away default risk here. If default does not occur, it doesn't matter what interest rates are, bond will always pay face value at maturity. So once we've got that value, we can start bringing that value back through the tree at the appropriate rates that the tree has generated. And of course, at each node in the tree, if we know the bond value, we can automatically work out the payoff of that call option or put option as well. So similarly to the share price tree, therefore, we can then compute the payoff of that option today. So start by looking at the terminal value of the option and then apply discount, apply time value of money discount to bring the value of that option back to today. Remember, the probabilities, of course, will be easier because they are 50-50. And also, we can use a binomial interest rate tree to value caps and floors. Now remember, caps are made of caplets, floors are made of floorlets. But what are those? If I have a floating rate note, okay, I'm a corporate entity who has borrowed at a floating rate. What is the big risk I face? Well, the big risk I face is that LIBORs could skyrocket. And of course, if my floating coupon is tied to LIBOR, then my variable payment will skyrocket too. So how do I hedge as a risk manager? How do I protect myself against this potential increase in LIBORs? Well, I want to get myself a cap. Again, if you think about your your coupon, right, on a floating rate note coupon, FRN stands for floating rate note. So your coupon can go up and down, I'm exaggerating here, it can go up and down as a function of LIBOR. Now, from the point of view of the company that borrowed at a variable rate, they may want to set a cap. Let's use another color for that. There you go, they may want to set a cap up here. And of course, the advantages are obvious. If I set a cap there, I'll never actually have to pay more than the cap rate. So I know my theoretical maximum exposure. Now, who might want to set a floor? Surely not the company. Because if LIBORs were to go down to zero, and if I were to have to make a zero payment to my lender, well, I've got no problem doing this. I'd be happy. But so I'm not going to be interested in setting a floor myself as the company. Who might want to set a floor? Well, the floor will be set by typically the lender. So a bondholder would be worried that as LIBORs decline, the coupon payment will be less and less, so they may want to set a floor to guarantee a minimum payment to be received. So just to write, floor is set by the lender, cap is set by the borrower. Now, we can also extend this to the argument that you can have a collar, you can have a cap and a floor at the same time. And there are other readings where we will look at this properly. But the point is, if we've got both a cap and a floor at the same time, then the effective coupon that we pay is that the coupon will be variable between the cap and the floor, but it will be fixed if LIBOR exceeds the cap or indeed falls under the floor. So this is a little bit of a warm-up on what we are trying to achieve. But how do we actually set the cap? We still haven't said this. In order to set the cap, guys, you would need to buy, or the company, the borrower will need to buy a series of call options on LIBOR. Okay, so to set a cap, you buy a series of call options on LIBOR. The strike of those call options becomes the cap rate. So that's the strike of the calls. So each call option is referred to as the caplet. The collection of these call options is known as the cap. Similarly, if I were the lender, the bondholder, and I wanted a floor, how do I set a floor? So this guy, how does he do it? Well, he buys a series of put options on label. Okay, that's how it's done. So a series of floorlets will then create a floor. And again, why are we talking about that? Because we've got a binomial interest rate model. So we can value these couplets and floorlets with the binomial interest rate model, and we can therefore know how much we need to pay to our dealer, or our dealer needs to know how much to charge us in order to sell us this form of protection. Right, moving on to the Nobel Prize winning Black-Scholes-Merson equation. Here we see it in its entire beauty. Before you panic, guys, the Black-Scholes-Merson equation is no longer a computational learning outcome. So we simply need to understand it, appreciate it, know what the inputs are, and know how the changes in those inputs affect the value of the option, know the assumptions and the implications of those assumptions. But in a nutshell, here we see the equation for a call option, and we can see the usual suspects here. We've got the stock price today, we've got the strike price, we have the risk-free rate of return, which is continuously compounded. T is, of course, the time to maturity. And then we've got two elements here, ND1 and ND2, which are probabilities based on the cumulative normal distribution. So you should be familiar with that from level 1. Now, let's understand what this equation is actually trying to do. We're not obviously going to derive very much. As I said, it's a Nobel Prize winning equation, so the mathematics is fairly advanced. But essentially, if you were to exercise that option, then there will be two things happening. There will be a payment, because you'll have to pay the strike price. And there will be an inflow, which is the idea that you will receive the stock or its monetary value. So let's look at the outflow first. This is, I guess, the easier bit to understand. This part of this box here would be the outflow. So if we do exercise the option, we'll definitely have to pay the strike price. All right? So that's the outflow. But we only pay that at maturity of the option. So for that reason, we are discounting the strike price at the continuously compounded risk-free rate between maturity and today. Not only that, but we also have to come up with a probability. This ND2 is the actual probability that the option will indeed get exercised. So in other words, this is the present value of the expected payment that we will have to make if the call option does get exercised. Now moving on to the left-hand side here, the stock price times ND1. Well, we said ND1 is also a probability, but here we've got a slight problem. ND1 we can think of as the probability of exercise, but it is an adjusted probability. And let me explain why this occurs. Basically, I can start with S0 today, and I can have an evolution of prices, as we've seen with the binomial tree. Prices can move in various directions. I'm going to come up with several scenarios here. S4 and S5, and we can see that basically these are possible stock prices in the future. And of course, if I take maybe the arithmetic mean of this should give me the expected value of the stock price in the future. But now here's where the problem lies. We don't get the expected stock price in the future if we exercise the option. Why? This is because we know that if we've already exercised the option, we must only be looking if I imagine that this cutoff line was the strike, if I know that I'm exercising the option, it must mean that I'm only looking at the stock prices above the strike price. So in other words, what's relevant to me is the expected stock price given that that stock price in the future has ended up above the strike, i.e. given that the call option has actually ended up being in the money. And now would you all agree that the expected stock price of S1 and S2 must definitely be greater than the general expected stock price, which is the arithmetic mean of S1 through S5. And for that reason, basically, whilst we can think of ND1 as a probability of exercise, it is actually an adjusted probability of exercise. And if we go back to the slide, you will notice that in practice ND1 will be slightly greater than ND2 for the reason I'm explaining. Also, it's interesting to note, and we will mention this again in a couple of slides' time, it is interesting to note that ND1 actually has a special meaning as far as we are concerned, because ND1 will be one of the option Greeks we will be studying. In fact, ND1 will be the options delta, the call options delta. And again, we see the same equation here. This is the equation for the call. As I said, the ND1 and ND2 are cumulative probabilities. The D1 and the D2 can be thought of as essentially Z statistics. So this is how they are computed. So this is the D1 and these are the D2. I couldn't agree more with this comment here. Do not try and memorize these ones. Focus on the big picture. One key thing, of course, that you need to notice is that BSM only works for European options. We cannot use Black-Scholes the value American options. So what could I use for American options then? Well, of course, it's the binomial tree that we're already familiar with. Okay, and now let's look at the various inputs that go in the BSM equation. Well, T is the time to maturity, of course a very important input. Stock price is also there, strike is also there. Risk-free rates impact the value of calls and puts. In a minute we'll see how. Volatility, the underlying asset standard deviation, and of course the famous ND1 and ND2. Remember, ND2 was the probability of exercise, ND1 was the options delta. Whatever that means, we'll see in a few minutes. Right, what are the assumptions of this model? And I think this is where you gotta be focusing, because whilst the computation is probably beyond the exam, the assumptions and the implications of those assumptions are fairly important. So, the underlying asset price follows a log-normal distribution. Well, we already know that log-normal distributions are bounded by 0 on the left-hand side. So in other words, they are perfect for modeling asset prices. Secondly, returns are assumed to be continuously compounded and returns are normally distributed. We are happy to use the normal distribution as far as returns are concerned, because the normal distribution can go all the way from positive infinity to down to negative infinity. The next point is about the risk-free rate. Well, the risk-free rate in this model is not only known, of course, we need to know it in order to input it in the model, but it's also, key point, it's constant. So this model will not allow me to shock interest rates up and down. So that is a key distinction from another model that we've seen, which is the binomial interest rate model, where interest rates are shocked up and down. Okay, and then we've got volatility assumptions. This is relating to stock volatility assumptions. Again, the volatility of the underlying is assumed constant. Now, markets. Markets are frictionless. This is, of course, an ideal assumption. Frictionless markets would imply that we don't pay taxes, we don't pay commissions, there are no transaction costs, there's no bankruptcy. What an ideal world. And finally, underlying asset has no cash flows. In other words, the original BSM model of the 70s was actually developed in the absence of dividends. Now, is that a problem if my stock actually pays dividends? No, it's not. Yeah, you can easily modify your original Black-Scholes-Merton equation to accommodate dividends for both calls and puts. The one assumption that is kind of fixed in stone and that we cannot modify is that the options will have to be European style. Okay, now, of course, based on these assumptions, we are going to see certain limitations as well. So, because the risk-free rate is a constant value, this kind of model will be nearly useless for the valuation of anything to do with bonds, because bond prices are highly dependent on interest rates and on the movement in interest rates. So we can't use Black-Scholes to value options on bonds or bonds with embedded options, simply because interest rates are assumed constant. In other words, we are assuming that there is no interest rate volatility. Sigma of yield equals 0. Again, we have seen the binomial interest rate tree model, and that is what we need to use if we want to value anything to do with bonds, calls on bonds, put on bonds, etc., etc. Secondly, the constant vol assumption. How realistic is that? If we go back to September 2008, if we go back to March 2009, these were tough periods, lots of things, lots of event happens, and the volatility that came with those periods was much higher than the volatility of prior periods or following periods. So we're probably not gonna enjoy constant volatility in the markets, most likely. Of course, in practice, we will have taxation, so markets won't be perfect, won't be frictionless, and we will be paying transactional costs. And of course, if you want to price your American options, you will need to resort to the good old binomial stock price tree. Okay, now let's get started on the topic of the option Greek. So we're basically responsible for 5 option Greeks, which are delta, Vega, Theta, Rho, and Gamma. Okay, Gamma is actually not on this slide, but it's coming very soon. So delta is governing the relationship between the option and the stock. Okay, more on that on the next slide. Vega, think Vega will be volatility. By the way, Vega, even though it is an option Greek, is not a Greek letter. It is a constellation. Nice, interesting trivia fact. Risk-free rate, of course, will be governed by Rho and the passage of time, so the sort of relationship between time ticking away and the value of the option will be governed by Theta. And unfortunately, the strike price ends up not having its own Greek letter. Sorry about that. Now, let's have a look at the nitty-gritty behind all these things. So first of all, in terms of delta, what delta is doing is it's looking at the change in the call price as the stock price changes. Okay, and I'm using call price here, but you can comfortably replace that with the put as well and see what happens there. Now, so the first thing we know is the delta for a call has to always be positive. What that basically means is there's a positive relationship between the stock price and the call. As the stock price appreciates, the call becomes more valuable, and vice versa. As the stock depreciates, the call becomes less valuable. With the put, delta is always negative. And this is because we've got an inverse relationship. If I've got a put, I want the stock to become less valuable. That will increase the value of my put. All right? And in terms of ranges, a call delta ranges between 0 and 1. Put delta ranges between 0 and -1. And again, the rule of thumb is very simple. The more out of the money an option is, be it call or put, the closer its delta will be to 0. The more in the money an option is, the closer its delta will be to an absolute value of 1. So ignoring the minus sign, it will be closer to 1 in both cases of calls and puts. Now Vega and volatility. So this will be the sensitivity of the call to changes in sigma. Remember, sigma was the standard deviation of the stock and therefore our stock volatility. Well, good news, guys, this is an easy one to remember. In both the case of calls and puts, Vega is positive. What that basically implies is that if I increase stock volatility, this must also increase the value of our options. And why is this happening? What's the reason for this? The reason is this. Remember, let's take a call. What's the payoff of a call? It is the greater of 0 and S minus X. So in other words, I either get some profit if the stock price goes up, or I get 0. I can never get less than 0. But of course, higher volatility will increase the profit on the upside. So higher volatility increases the expected value of our call. Okay, so that's the point. So that's why we say when hedge funds and when traders have bought options, we say they are long volatility. If volatility increases and you've bought options, you are winning. Whereas sellers of options are known to be short volatility. Sellers of options will tend to be hurt by market events which trigger higher levels of volatility. And now the risk-free rate. So the risk-free rate, we're going to look at the change in the call value with respect to changes in the level of interest rates. And you can see here rho is positive for calls. In other words, it's good to see higher rates if you own call options, but it's not so good if you own put options. Now, how am I going to remember this relationship? One little trick I use is I resort to the put-call parity. So put-call parity tells me that call plus bond, remember 0 coupon bond, face value strike, is equal to put plus stock. So if I isolate the call on the left-hand side, I will end up holding a put, a stock, and a short bond position. Now what does that mean? It basically means that I now have a framework to understand what happens as rates go up. First thing that I notice as rates go up is that bond prices must come down. Now, because I want to focus on the impact of the call, I'm going to for the moment assume that the rates have no impact on the put and no impact on the stock. If bond prices have declined, then that would mean that the call value has increased as rates increased. Notice that this is a positive relationship, so therefore we have positive rho. Okay, and of course a similar argument can be used to demonstrate that in the case of a put, as rates increase, put values will actually decline. Okay, next Greek is theta. Okay, so what is theta measuring? Theta will measure the change in the call value as time passes. Okay, so perhaps a better way to think about theta is not in terms of time to expiration, it's in terms of the passage of time. Okay, so we want to basically look at how our values of calls inputs are affected by the passage of time. And think of options as depreciating assets, much like your car, for example, is a form of option because it allows you to drive on a weekend or go and do your groceries. It is an option. A car is an option. But meanwhile, as it sits in the garage or in front of your house, and as time passes, that car depreciates because it has limited life. In the same way, a call and a put, because they have limited life, will depreciate with the passage of time, and that's going to be governed by the Greek theta. The case of calls and puts, theta is going to be negative. In other words, as time passes, the value of calls and puts will decline. Now, this is definitely true in the case of calls. This is usually true in the case of put, but not always. Can you think of an example of a put where perhaps this may not be true, where perhaps theta may be positive? And this would occur perhaps in a very deep in the money put. So for example, let's say I own a put on an asset that is nearly defaulted or in severe financial distress. My put is already deep in the money, nearing its maximum payoff. So if it is a European put, I still have to wait until expiry in order to monetize my profit. Simply by waiting, I won't get more. So in the case of European deep in the money puts, it's actually advantageous to have shorter maturity than longer ones. And finally, the relationship between exercise price and the payoff of calls and puts, of course, goes back to our computations, if you want, of intrinsic values. So for calls, it's S minus X. So if I were to increase the value of the price of the strike, I would definitely be looking at a less valuable call because its intrinsic value will decline. So there is an inverse relationship. A call that comes with a higher strike price is less attractive because it essentially forces you to purchase the asset more expensively. If I look at a put, I'm looking at strike minus underlying being my intrinsic value, and of course increasing the strike here is very advantageous because it basically allows me to sell my asset at a more attractive price. So there is a positive relationship here between the strike and the value of your put. Okay, now going back to our delta. Delta can be computed in two ways. We can have a discrete computation that essentially comes from the binomial tree, or we can have a continuous computation that comes from Black-Scholes. So let me show you first an example of what the discrete delta might look like. So let's say I've got $10 of a stock price today. Stock price can go up to $12 or down to $8. And let's say I'm interested in the delta of an at-the-money call. And remember, at-the-money simply means that the strike of that call has to be equal to today's stock price, in our case, $10. So let's use blue color for the payoff of the actual option. So in the upstate of the world, the options payoff will be 12 minus 10 or $2. In the downstate of the world, because exercising will cause us to lose money, the payoff will be $0. So how will I approach the so-called discrete delta computation. Discrete because we're using a binomial tree which is made up of a discrete number of branches or steps. Well, the discrete delta will be the change in the change in the call price with respect to the change in the underlying price. Okay, so essentially in our case, the change in the call price will be the movement between $2 to $0, and we'll have to divide that by the change in the stock price, which is a change from $12 to $8. And that, of course, gives me 2 divided by 4, or 0.5. So in other words, that is the delta of approximately the delta of an at-the-money call, which is not far from the truth. Because logically, if a deep in-the-money call has to have a delta of 1, and a deep out-of-the-money call has to have a delta of 0, then a at-the-money call has to be somewhere in between, approximately 0.5. Now, it's actually more complex than that, because, of course, dividend payments will affect the delta. But as a ballpark figure, this works very, very nicely. Now, how am I going to interpret that delta, 0.5? What I can say is that for $1 change in the underlying, call will change by 50 cents. That's basically the meaning of delta. So if I take $10 change in the underlying, then the same logic would suggest $5 change in the call. Now, delta alone won't work very well for large changes in the underlying. We do tend to like to use delta for only small changes in the underlying due to the convexity of the option premium price, option premium curve. Okay, so that's why we're also going to study gamma, which is looking at the curvature. But this is how we work out discrete deltas. Now, how do we work out continuous deltas? And the good news here is that it is a number you can simply pull out from the BSM equation. It is nothing but ND1, which, remember, we discussed could be viewed as the probability of exercise, however, adjusted upwards. Now, also, of course, we've got the puts. Put delta is between 0 and -1. So if we wanted to estimate it or compute it continuously, we would take the call delta from Black-Scholes and subtract 1 from it. So, for example, if ND1 was 0.5, that would imply that the corresponding put delta would be -0.5. Right, and this is a nice graph of actually what delta is, because the red curve that you're seeing is essentially the option premium. Okay, and if you take a point, so let's take this point here, the slope at this point is essentially the change in the call price with respect to the underlying. But of course, that is how we define delta in the first place. So delta is the slope of the option premium curve. And you can see how nicely this works. If you take this area here, where the slope is essentially a flat line, well, that would signify a delta of 0. If you take this area here, where we're deeply in the money, we are going to be looking at a gradient of 45 degrees, which is a delta of 1. So again, logically, at this point, this is where the strike is. So this point is where your at-the-money call will be. We are expecting a delta of 0.5. So let's see how we can estimate the change in the call prices and put prices using deltas as an estimator. So we already know that delta C, or change in the call price divided by change in the stock price, is approximately equal to the ND1. So if we take that equation and rearrange it, we then get this particular statement. We can estimate the change in the call price by taking the delta from BSM, the continuous delta as we say is ND1, and multiplying it by our expected change in the stock price. Now, if we wanted to do the same for a put, we would then take the estimated change in the stock price, but multiplied by ND1 minus 1, which of course is the put delta. Okay, so a nice little summary of delta now. So call deltas are values between 0 and 1. As the option moves in the money, delta approaches 1. As the option moves out of the money, delta approaches 0. And put deltas are values between minus 1 and 0. As the option approaches in the money, as it gets in the money, delta approaches negative 1. As the option gets out of the money, delta approaches 0. Call delta is ND1 from Black-Scholes, put delta is ND1 minus 1. So this was essentially just a summary. Okay, and here's another example of how we could compute discrete time delta. If we knew that the call option will go up from $2 to $2.20 when the underlying rises from $40 to 40 spot 50, all we need to do is simply plug that in the equation. So on the top here we are looking at the change in the call price, and in the denominator we're looking at the change in the stock price. So it's 20 cents for the call and it's 50 cents for the stock, which gives me a delta of spot 40. So as we said earlier, one way to interpret this delta is to say that this is the expected change in the call price given $1 change in the underlying. Okay, and here's an example of estimating the change in the call price. So an exam question could, for example, provide ND1. And again, if we don't know that ND1 is call delta, we will be in trouble at that point. But ND1 is the call delta from BSM. And we know this is spot 80.51. If the price of vanilla stock increases by 50 cents, what is the approximate change in the call value? Well, nothing easier than this, guys. All you got to do is take the delta, multiply by the estimated change in the stock price, and you get the estimated change in the call price of 40 cents. Okay, the next thing we're going to look at is quite interesting. It's delta neutrality, delta neutral hedges. So there are actually two ways to set up a delta neutral hedge. The first way is to have long stock which you want to hedge. So how would you protect a position of long stock, long shares? Well, one way to protect it is to buy puts, right? And what was that called? This was called protective put, because we're essentially protecting the downside of our stock. Another possible strategy, which is again a hedging strategy, not as powerful as buying puts, but still can provide a little bit of cushion on the downside. This strategy involves shorting calls, and this in finance is called covered call. Now, what's the idea behind buying stock and selling calls? Well, the idea is that if our stock declines, of course, we will incur, we'll suffer losses on our main position, but we've sold calls on the stock, and those calls will become less valuable. So we can basically close our call positions at that point for a profit. That profit will provide some comfort for the losses that we're incurring on the long position. Now here's the big question. Let's say I've got 1,000 stocks, 1,000 units of share, so 1,000 shares. How many short calls will I need? Will I need 1,000? Will I need more than 1,000? Will I need less than 1,000? Okay, so for example, in a multiple choice question, they can say A, B, and C. And they could say, okay, you actually need, so the number of short calls are 500, 1,000, 2,000, right? And sometimes there's just an intuitive way to know what the right answer is without any computations. But just by looking at the three options, I already know which the right answer is, even though I'm not even given a lot of information in this question. The point that I'm trying to make is that the call delta, which is going to be the determinant of the number of short calls, the call delta, which is our ND1, is a number that has to be less than 1. Okay, I suppose there is this hypothetical exception of very, very deep in the money call, which has a call delta of 1. If we ignore that, your typical call option has a delta less than 1. So for example, I could have a delta of 0.5. Now remember what that means. For $1 change in the underlying, the call price changes by 50 cents. So in other words, every time I lose $1 on the underlying, the short calls will produce a profit of 50 cents. So half the amount of the loss. So it's no good to try and hedge by having 1,000 short calls. That simply won't be enough. I will need 2,000 short calls, each of which will provide 50 cents of profit for each $1 loss on my shares, and that will provide essentially a perfect hedge. So if we want to think of it as a formula, the number of short calls has to be the number of shares divide ND1. So in our case, we're taking 1,000 divided by 0.5 gives me 2,000. The only feasible answer really by inspection, because most of the time in an MCQ scenario, you're looking to hedge yourself by buying either more puts than the number of shares or shorting more calls than the number of shares. That's of course assuming that ND1 is less than 1. Okay, the next one that we need to look at is of course the fifth and last Greek letter, which is gamma, and that's going to look at the rate of change in delta as stock price changes. Okay, so let's see what that means. So gamma is the change in delta as the underlying price changes. And it's interesting because if I just write what delta is the change in the call value as the underlying changes. You see? So delta is looking at the sensitivity of the call to the change in stock price. Gamma is looking at the sensitivity of delta to changes in the stock price. It gets quite confusing. That's why I sometimes like to think of a more practical example that you can relate to. Speed and acceleration. Speed and acceleration. Well, speed looks at what? At how distance is changing as time passes. Acceleration is looking at how speed changes as time passes. So you can almost think of delta as speed and gamma as acceleration. Right. Okay, so effectively, if I had a gamma of 0, it would mean that I'm kind of traveling at a constant speed, i.e. my delta isn't changing. So gamma of 0 means delta isn't changing. Very, very high gamma will mean that delta's kind of volatile. Delta wants to change even for small movements in the underlying. Now let's look at a picture of gamma. So here's gamma on the vertical, and on the horizontal is our moneyness. Okay, so we're going to have our moneyness here. So we've got out of the money options, we've got at the money options, and of course we've got in the money calls as well. So what gamma will look like, change the color, gamma will look like that pretty much. So the moral of the story, the message from this picture is that gamma will be highest at the money. You can think of it as we've got the greatest amount of uncertainty at the money. Gamma will be very low for options that are either deep out of the money or deep in the money. So when we've got a deep in or out of the money option, because gamma is so low, delta isn't really changing as the underlying changes. If I've got an at the money option, be it call or put, gamma's high, so it means even small changes in the underlying price will affect the delta. But now, why do we care about all that? So let's go back to the slide and see what we've learned from all this and what conclusions we can draw. Okay, well, first of all, we said that gamma is largest at the money. Yes, we know that. And we know that it is lowest for in the money and out of the money options. Now, there is also a relationship with expiration. If you really want to minimize your gamma, you want to buy options that are long dated and are out of the money or in the money. But now, here's a very, very interesting question. Going back to our delta neutral hedges. Delta neutral hedges are known as dynamic hedges. And the reason why they're known as dynamic hedges is that once you set that hedge, it only protects you for a very short period of time. If you go back to the example I gave you, I had 1,000 shares, a delta was 0.5, so I had the short 2,000 calls. Let's say tomorrow, the stock price moves down. Now, as the result of the stock price moving down, tomorrow's delta will no longer be 0.5, it'll actually be a number less than that. So my hedge will no longer work perfectly, right? It will no longer be good enough. And whether I'll need to hedge or not hedge will depend on how significant that movement in the delta was. So the point we're trying to make here is that every time you rehedge, you incur trading costs. And your hedge can become very, very expensive. So to minimize trading cost, you want to use either in or out of the money options, not close to expiration, because those kind of options will have low gamma. And as we said earlier, remember gamma's acceleration. If we've got low acceleration, it means our speed is not changing. It means our delta is not changing. And of course, if our delta is not changing, if I still have a delta maybe of 0.49 from 0.50 to 49, okay, it's not a big deal. I don't have to rehedge straight away because my hedge still works fairly well. So make sure you use in or out of the money options not close to expiration to reduce your trading costs. Okay, now moving on to historical and implied volatility. Maybe we should start with the second one here, historical volatility, because this is kind of bread and butter way to work out volatility. Okay, backward looking measure. So I could, for example, ask you, okay guys, what is the historical volatility of returns over the past trading month? Well, how are you going to work that out? Well, first of all, it all starts by computing the continuously compounded daily returns. And to do this, you simply take the price today, divide by the price on the previous trading day, and then, of course, if we want continuous returns, we need to take the natural logarithm of that. So this will compute the x's of our formula. Once we've got the x's, or the continuously compounded returns, we then proceed to compute variance and standard deviation of those returns. And that is what we mean by historical volatility. Now, whilst this is a useful metric, at the end of the day, historical vol is a backward-looking measure. We want to be able to look forward, especially as traders, especially as analysts. We want to look forward, not backward. So that's where implied volatility comes into the picture. Essentially, what implied volatility does is it drives the Black-Scholes-Merton option pricing model in reverse. In a traditional sense of the model, we would input volatility and get the price of the option out of it. What we're going to do now is we're going to take the option price as determined by the market, by the forces of supply and demand. We'll take that and use it as an input into the Black-Scholes-Merton in order to understand something about what markets think is the relevant stock volatility that we expect to see going forward. Now, of course, you can't just rearrange the BSM equation. You saw that equation. You can't just rearrange it to get sigma to equal blah, blah, blah. You can't do that. You can't use basic algebra. So what you tend to do is you tend to do a little bit of sensitivity analysis as they've provided in this table. We take different vol levels, and given those different vol levels, we compute different BSM prices for our option. But what we do now is we go out there and check what the actual market price is at that time. And let's say that vanilla's right now trading at 7.25. Now we go back to our sensitivity table and say, well, look, 7.25 is somewhere in this neighborhood. So it means markets are pricing in a volatility of anywhere between 40 and 45%. And that is what we mean by implied volatility. And that is how we compute volatility going forward. So forward-looking as opposed to backward-looking view of volatility. Okay, now cash flows and the underlying asset. This is going to be an easy concept. Okay, we're gonna first start with the good old intrinsic value of a call. So intrinsic value of a call is either 0 or S minus X. Now ask yourself, what will be impacted in this equation if that stock were to pay a dividend? And of course we know that when stocks pay dividends, cash leaves the company. On the ex-dividend date, stock prices tend to decrease. So if I reduce my stock price, I'd basically be reducing my intrinsic value. So essentially paying a dividend will have a detrimental impact on the value of your call options. Intrinsic value of a put is of course X minus S. So as I pay a dividend, stock price declines and intrinsic value increases. So it's the opposite logic. Higher dividend yield will actually increase put option values. Now, if we then go to the continuous model, which is the BSM, we can continuously impact the stock price by essentially multiplying it by e to the power of negative dividend yield, that's continuous dividend yield, times time to maturity. Okay guys, we're nearing the end of this video, but I want to show you a couple of more concepts. One of them is the forward put call parity. So this is essentially a variation of your bread and butter put call parity you saw earlier. that had a fiduciary call, i.e. a call and bond, and a protective put, i.e. a put and stock. But of course the call and the put in that case were written on the stock. In the forward put call parity, the call and the put are actually written on a forward contract. Again, we have two portfolios. Portfolio 1 will have a call option on the forward and a discount bond with a face value. This time it's a little bit weird. The face value is not just the strike of the call, it's actually the strike minus the forward price. I'll explain that in a minute anyway. Portfolio number 2 has a put option written on the forward contract, and then of course the very forward contract, a long position in the forward contract. Now of course the trick here is that much like what we did in the put call parity, we can show that the payoffs in all states of the world are the same. So in other words, again, we get the result where portfolio 1 is equal to portfolio 2, and we can therefore create synthetics, discover arbitrage opportunities, or price one of the 4 items if we've got the other items. So this is what the equation looks like. But I just wanted to give you a little bit of a hint as to how you may try to remember this equation. Especially this may be a little bit unusual, this face value of the bond, which is strike minus forward price. So what I normally do at this point is I remind myself of the basic put call parity equation, which is call. There's a 0 coupon bond, and we're looking at the present value of that. There is a put, and there is a stock. And this worked very fine with essentially calls and puts on underlyings. Now what we're going to modify here is we're not going to have a stock. Instead what we're going to have is a forward price. So you're going to FT. So we still should have a call. We'll have this present value of X at the issue rate to maturity. We will have the put, but now we will have a forward price. Now remember, what's the difference between the stock and the forward? If you had to buy a stock, you would have to stamp up money up front. But with the forward contract, all you have to do is essentially sign up a piece of paper saying, I promise to buy at a future date. So in fact, the present value of that future monetary obligation is simply the present value of the forward price. So I will have this bit in the equation. Now notice that X and F have the same denominator. So what I can do is take this item and move it to the left-hand side. And effectively what I will end up having is a call on the forward plus a bond whose face value will be X minus the forward price, discounted at the risk-free rate to maturity, and then on the right-hand side I'll simply have a put option on the forward. So this could be one possible way to familiarize yourselves with this equation and make sure that you remember it for the big day. Okay, American versus European options on forwards and futures. Okay, so let's make the first statement here. First statement is American options on futures are more valuable than European options on futures. So of course, with futures, remember, we've already talked about this in the futures reading, so make sure you review that. Futures are marked to market. So if I have a deep in the money American option on futures, I can exercise it early because it's American, and I can get mark to market immediately. I can then withdraw those excess profits and invest them elsewhere. Surely that's got to be attractive. If I had a European option on futures, well, unfortunately, even if the option was in the money, because it was European, I would still have to wait until the expiry of the option to actually monetize the profits. So when the options are written on futures, it is preferable to have an American option compared to European option. And that is because of the marking to market feature. Now, if we compare American versus European options on forwards, we're not going to have this difference, because forwards are not marked to market. So even though I can exercise my deep in the money American option on forwards early, I'll just end up holding a forward contract. Unless I can somehow mark to market that forward contract, there will be absolutely no difference between holding an American option or holding a European option. And finally, we need to talk about the black model. So of course we already know something about the Black-Scholes-Merton model. It is a continuous model that allows us to value options on underlying assets. Well, Black goes solo here to develop a model for forwards. So essentially the main thing that happens, the model itself will look very, very similar, but the main thing that happens, of course, is we substitute the discounted value of the forward price for the stock price today. And again, I couldn't agree more with this comment. We're not going to be trying to memorize this formula. We're going to try to understand the application of this model. So notice here that the equations do look very similar, but instead of the stock price, we're now seeing the forward price. Guys, we've reached the end of this wonderful video. Thank you very much for watching. I think this is an important reading. We covered a lot of technical material. Certainly binomial trees can be a little bit of a time burner on the big day. Black-Scholes-Merton, yes, there's a lot of calculus behind it. It's a Nobel Prize winning equation. However, from the point of view of exam day, this is actually quite conceptual and not so mathematical. We also looked, of course, at the famous options Greeks, delta, gamma, vega, theta, and rho. Again, this is very conceptual. Understand what these exposures refer to, understand when they are high and low, and how they differ for calls and puts. Dynamic hedging, delta neutral hedging, is of course a big point as well. We also saw how to minimize your trading costs by using options with low gamma. And we also looked at variations of the put-call parity for forwards and also the black model for forwards. So thank you very much for watching, and I hope your studies are going well. All the best, and see you soon. Goodbye.